Welcome back to Alpha Recap. I'm Joe, and with me today is Ben, our crisp commodities expert and general market sense maker. We'll run through the big stories from the day and why they mattered. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here, Joe. Plenty to unpack from a fairly choppy session.
Right, let's jump in. Markets closed mixed today, but there were some loud headlines. The three things that really set the tape were a big move in leveraged tech exposure with ProShares Ultra Pro QQQ, a spike in retail panic around Bitcoin, and an analyst note on Equifax that tightened the narrative around data company margins. Ben, start us off with that leveraged ETF move. What happened and why it mattered?
ProShares Ultra Pro QQQ finished the day down just over 4%, and it did that on very heavy volume. About 150 million shares changed hands. When a leveraged ETF moves that much on that kind of volume, it wasn't just a one-off price flicker. It told you traders were de-risking tactical, amplified exposure to tech. Those products are built to magnify daily moves, so when the underlying momentum wobbled, the ETF exaggerated that wobble and created outsized flows.
So in plain English, the ETF acted like a mirror that made the wobble look bigger.
Exactly. And because leveraged ETFs rebalance daily, big outflows or forced trades can create liquidity stress. If you were trying to buy or sell large blocks, you could have seen worse slippage than usual.
That dovetails into the crypto noise we saw. Searches for Bitcoin dropping ballooned to about 10,000 searches, up 300%. And interest in cryptocurrency trading also rose to about 10,000 searches, up about 75%. That sounded like retail panic. How did that feed into broader risk sentiment?
Search spikes like that are a classic indicator that retail traders were alarmed and engaged at the same time. When lots of retail attention hits markets, two things usually happen. Liquidity can thin because order books don't behave like institutional books, and intraday volatility tends to increase. That didn't just matter for Bitcoin itself, it bled into crypto-adjacent stocks. Think Coinbase, the Grayscale Bitcoin Trust, and MicroStrategy, and into leveraged risk trades like the ETF we just talked about.
So it was a bit of a chain reaction. Crypto fear, retail flows, then broader risk off in levered products?
Yes, retail attention can both create panic selling and also attract fresh buyers chasing the move. That two-way action equals heightened execution risk. Large traders who weren't paying attention to on-chain metrics, exchange inflows and outflows, funding rates, could have been surprised by sharper price moves and wider spreads.
Speaking of on-chain metrics, what should traders have been watching today if they cared about crypto flows?
Keep an eye on exchange inflows and outflows, because big inflows to exchanges often preceded selling pressure. Funding rates on perpetual swaps tell you whether leverage was stretched on one side, and exchange volume gives you a sense of whether the move had breadth. If searches were up but exchange volumes were muted, that would be noise. Today, the combination argued for real retail engagement, not just headlines.
Let's flip to corporate news. Equifax had a price target cut from a major house. Stifel brought it down to $235, citing margin pressure on its FICO business. Why did that matter for the tape? Analyst
Notes like that are important because they shift the narrative from macro or headline risk to product-level economics. FICO-related margins are a meaningful revenue lever for Equifax. When someone of Stifel's size says margins are under pressure, quant funds, factor-driven investors, and discretionary managers can all reprice the stock quickly. It's a reminder that even in a headline-driven day, fundamentals still bite.
And that margin story is the opposite of the headline noise we were talking about. More of a structural thing rather than short-term panic.
Correct. Margin pressure is a structural issue until it isn't. Traders tended to treat it as a real, modelable risk, so it was an explicit catalyst for re-rating there.
A couple of other corporate items popped up. Boviet Solar reiterated production continuity amid a parent company strategic review, and Field Medical announced encouraging trial results for a new atrial fibrillation ablation approach. How did those fit into the day's mosaic?
They were good examples of the divergence we saw. Sector and company-level fundamentals were often at odds with headline-driven volatility. Boviet reducing delivery risk softened supply-side worries for solar modules, even if the ownership picture remained unresolved. Field Medical's clinical progress reduced technical risk for that specific medtech approach, which matters to long-term investors, but didn't move the needle for broader markets because it's still early stage and there aren't public financials attached.
So headline risk was loud, but underneath there were pockets of positive fundamentals.
Exactly. That's why we always say separate transient headline noise from structural trends.
Quick hits time. You had a useful run-through in the brief. Rich Tech Robotics had an investor class action notice covering purchases between January 27th and January 29th, 2026. That's small cap litigation noise. How does that affect holders?
Class action notices create legal overhangs that increase realized volatility for small caps. Sellers can freeze up and buyers demand a haircut. If the notice becomes a filed suit, you could see potential settlement liabilities emerge. For portfolio managers, these events are idiosyncratic and are often uncorrelated to macro moves, but they're dangerous in a weak market when headline risk compounds losses.
Account Tech research showed brokerage EBITDA performance was improving, which sounds like a decent structural positive for names like Redfin and Zillow. Was that something investors could lean into?
It was a constructive data point. If more brokerages were hitting sustainable EBITDA ranges, that reduces the sector's downside risk and can support multiple expansion over time. But you needed to see that reflected in upcoming earnings to consider it a confirmed trend. It's encouraging, but not decisive on its own.
Onto consumer signals. Searches for when will tax refunds be issued spiked to about 10,000 searches, up about 200%. Does that matter beyond being a Google curiosity?
It did. Search interest like that is a window into liquidity-focused consumer behavior. If people were focused on refunds, it suggested a short-term boost to discretionary spending could be possible once refunds landed. That can affect consumer discretionary names, payments, and even regional banks that service those consumers. But the calendar and official IRS timings were the real determiners of whether it translated into concrete spending.
From a practical trader or investor perspective, what should people have been doing after today's action?
Traders should have tightened risk controls and watched volume patterns into the next session. For the leveraged ETF, the key was whether heavy volume persisted. If volume calmed, the move might have been a liquidity event. If volume continued, it suggested a broader unwind. Longer-term investors needed to separate the headline-driven noise, search spikes, and levered freakouts from structural developments like brokerage EBITDA improvements or credible clinical trial wins.
Let's make sure we explain one concept for listeners who might be new to leveraged ETFs. Why do they exaggerate moves day to day?
Leveraged ETFs use derivatives and daily rebalancing to produce a multiple of the index's daily performance. Because they reset every day, their performance over multiple days can diverge from simply multiplying the index return by the leverage factor, especially in volatile markets. That meant when tech names were choppy, the ETF's path dependency amplified losses and gains, and heavy flows made execution harder.
Nice and simple. Okay, what were the 3 or 4 things you'd want every listener to remember from today?
First, retail search spikes mattered. They pushed crypto-adjacent volatility and could amplify swings in related equities. Second, leveraged ETFs amplified the day's risk-off, and heavy volume on those moves demanded caution on re-entry. Third, analyst notes still moved stocks. Equifax's margin story was a reminder that product-level economics can trigger immediate repricing. Fourth, beneath the noise, there were pockets of improving fundamentals like brokerage EBITDA and specific corporate operational reassurances.
As we wrap up, what should folks be watching when markets reopened?
Watch Equifax for any management commentary in response to the analyst note. Track Bitcoin on-chain flows and funding rates to judge whether the retail panic cooled or persisted. Keep an eye on ProShares Ultra Pro QQ's follow-through volume to see if the levered unwind continued. Monitor any legal filings for rich tech robotics, and look for upcoming brokerage earnings to confirm margin trends.
Brilliant. Quick final takeaways in a sentence each.
Retail attention can create real, short-term volatility. Don't ignore search spikes. Leverage products amplified today's risk-off, so respect execution risk. And fundamentals still mattered underneath. Don't throw out the structural stories when headlines get loud.
Fantastic. That's all for today's Alpha Recap. If you have questions about anything we covered, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll catch you next time.